Welcome to the company presentation of Encavis AG. My name is Christoph Husmann. I'm the CFO of Encavis. Encavis is a listed company and we are an IPP, an independent power producer of renewables. We solely own and operate solar and wind farms in Europe. Well, ladies and gentlemen, if you have a look on this chart here, on the left-hand side, you see a photo of our largest park, Talayuela, a 300 megawatt solar park in the Extremadura in Spain. This park is meaningful to explain to you the equity story and the specialties of Encavis, which differentiates ourselves from our competitors. And this is a very nice example for that. Talayuela is not only outstanding due to its sheer size of 300 megawatt peak, with that being one of the largest solar farms in Europe. No, it is totally unsubsidized. With Talayuela, we have cash inflows based only on private contracts and cash outflows on private contracts as well. And the financing as well is privately organized. So this park offers a very nice risk-return profile, which is attractive to our shareholders and which is, again, totally unsubsidized. Why is it so important to us? Well, in a nutshell, the equity story of Encavis is that we want to make the renewables really being a commercially sustainable form of energy production. What does that mean? Well, we strongly believe that an energy form which needs subsidies obviously is not commercially sustainable. And how do we manage to get parks commercially sustainable? Well, we try to reduce the risk and improve the returns just by managing these parks like any other ordinary business. We try to identify economies of scale and economies of scope wherever it is possible and to skim them for the benefit of our shareholders. Well, and how do we do that? In the end, you can separate our four segments in three layers. On one hand side, there is the own business we presented in our segments of solar PV and onshore wind farms. In this own segment, in our own assets, we own 2 gigawatt of capacities and operate and manage them throughout Western Europe. These 2 gigawatts, here we have an ownership between 88% in our wind farms and 99.5% in our solar farms. These parks are owned and operated by ourselves, so we try to improve them commercially, legally, financially, and technically. On the other hand side, we have another segment and another layer, which is the Encavis Asset Management. The Encavis Asset Management is a service business which is focused on pursuing projects to own created funds in which financial investors and financial institutions invest in these solar and wind farms. So we have here pension funds, insurance companies, banks investing money for 10 to 20 years into solar farms and wind farms. And we are offering the service in the asset management of pursuing such projects, suggesting them to the funds. The decision on the investment is then taken by the funds. And then we run these parks for 10 or 20 years and are remunerated for the due diligence, for the services we offer to them during the acquisition process, as well as for the operations and maintenance. So here in that segment, we have 1.2 gigawatt of solar and wind farms in Western Europe. In total, it is 3.2 gigawatt, which are managed by us and by the third layer, which is the Encavis Technical Service and Stern Energy. This is the backbone of the company in which we try to optimize all these parks, let it be the own 2 gigawatt parks or the asset management 1.2 gigawatt parks. In total, with the both businesses, we have the scale and with the different types of parks, the scope just which we help us to skim all these economies of scale and scope. Well, in our own business, we have a very special way how we source projects. And this is very important to understand and how we differentiate ourselves from other players in the market. On one hand side, you see in the market a lot of financial institutions which are desperately trying to get some returns in this low interest environment and detect renewables for them. Since they are not very much familiar with the renewables and do not know how to manage them, they usually acquire parks when they are already connected to the grid. So these parks are already generating electricity as well as cash. And this is useful for these financial institutions. Let it be funds, let it be insurance companies, bigger insurance companies. On the other hand side, we have some competitors which are integrated developers and owners. They are going into the planning phase and taking all the risk of the local permission and authorization of all these negotiations locally. This is something we believe can only be done by local developers, not by ourselves. So we don't go into the investment of already connected to the grid parks. Only in rare occasions, if we have an opportunity, we utilize that as well, but we do not go into auctions where we are going into bidding processes where we drive up the acquisition prices and drive down the IRRs. And on the other hand side, we do not go into the early stage development on the green field, taking all that risk of these sticky and lengthy permission processes. What we do is we go do something in between. And I would like to explain that to you, our approach. Well, as I pointed out, we strongly do believe that for the local content of finding the right land plots, of negotiating with the landlords, with the neighbors, with the local authorities, let it be the construction authority or the environmental authorities, with the politicians, that needs people who are locally, socially integrated and really do know the people and do have skin in the game. So these are local developers who sign a strategic development partnership with us and contribute a lot to the successful development of such parks. We have 12 such strategic development partnerships all over Europe, owing us a pipeline of 3.5 gigawatt in total. And this is really a symbiosis of two partners, the local developer offering us this local expertise of the development of such parks and going for us through the permission and authorization process. And on the other hand side, we contribute to this partnership financing. And when the parks are done and are so far permitted and authorized at ready to build, then we contribute our knowledge of PPA origination, project financing, and EPC and construction negotiation and realization. This is a very helpful combination because in these days, you cannot develop as a local developer a park and relying on a feed-in tariff, which is by state defined at the end, and then having a bank based on these guaranteed prices providing you with the project financing. Today, when the park is ready to build so that you can put the shovel into the ground the next day, you need to negotiate some price fixing mechanism. Let it be with a private off-taker who guarantees you a fixed price for the electricity for the next 10 years or so. And for that, you need to have customer relationships with these private off-takers. You have to understand what the loopholes and risks are in such a PPA contract, how they are allocated between the off-taker and the IPP, and which price tag you put to the certain risk allocated to one or the other side. And then the project financing relies on that PPA contract as we do as the investor. So to secure project financing for the construction, the PPA has to be negotiated in a proper way. On the other hand side, the PPA off-taker relies on the project financing bank because the off-taker understands that only with the project financing, the park will be realized and will generate the electricity which he wants to buy over the next 10 years. And the same applies to the EPC contract, which has to be strict and qualified for project financing as well as a good feeling for the PPA off-taker. You see, that is pretty complex negotiation for which you need the trust and the relationship to these specific off-takers, banks, and construction companies. And this is what we bring to the table and contribute to this partnership. We secure these parks already at mid-stage, so in a pretty early stage, by paying some reservation fee. In return to that reservation fee, we either finally acquire these parks, closing condition precedent, and do the realization, or we already get handed over the ownership in such parks. And this helps us to secure a pipeline, having the developer, the local developer in place, helping us to realize the park, and we again contribute here as well. The 3.5 gigawatt of capacity spread over 12 strategic development partnerships in 11 Western European countries is in different stages. Some of these parks, 2 gigawatt, an early stage. Here we expect, with a probability of 20 to 40% of realization, that they will come into play in 2024, 2025. The remaining 1.5 gigawatt are already onboarded. That means we already have paid the reservation fee, and in most cases, in 2/3 approximately, the ownership of the SPV is already handed over to us. But we announce them usually when they are ready to build, and we already have secured a PPA and a financing for that park. This already applied for approximately 200 megawatt, which are already ready to build and are currently under construction. Other parks of 300 megawatt magnitude are in late stage, and 1 gigawatt are in mid stage. So we expect these projects to be realized between this year, maybe next year, or until 2025, but with a much higher probability. 2/3 of such parks already they're spread over 11 Western European countries. 2/3 of such parks are in Denmark, Germany, Italy, which we considered to be the hot places for PV in the years to come. All the pipeline is in PV. If you then have a look into the question, how do we finance such acquisitions over the next years, then you have to understand the commercials of such parks. With the signing on the acquisition of such parks and the price fixing for the electricity produced, and the produced electricity is usually in the long term pretty stable, you can assume that the revenues are more or less fixed for that project over the next 10 years or 20 years. This revenues after the cost, so the operating EBITDA of that park, then is the basis for the project financing, because the full project financing over the price fixing period will then be amortized and the interest payments will be paid to the bank. So the amount of the EBITDA generated or the operating cash flow generated by such a park defines over the period of the price fixing time the debt capacity. The debt project financing is at its peak at the very beginning, at the very first day when the park is connected to the grid, and then is fully amortized over the period of that price fixing contract. If it is a 20 years feed-in tariff in Germany, there is an 18, 19, 20 years amortization schedule. If it is a 10 years PPA, then it is a 10 years or so amortization schedule. With the ongoing regular amortization of the debt, since the interest rate is fixed, the interest expenses are reduced year on year, and then more cash flow and more profit belongs to us, the company, or you, the shareholder. When then the price fixing mechanism is over, the major chunk of cash outflow is gone because the debt is fully amortized and the interest paid. Then we have not a fixed price for the electricity anymore, but we have much more reduced cost with the park and therefore are more flexible. In the so-called golden end, which starts right at the end of that price fixing mechanism and with the end of the full amortization of the debt, we only have then the revenues, a fixed gigawatt hour production, but the pricing is obviously not fixed yet, but will be fixed then. And against that, some very low cost. Please have in mind that right away from the start, usually in solar, we have an 80% EBITDA margin, and wind approximately 75% EBITDA margin. So the operating costs are pretty low. Since then, we don't have any amortization payments or interest payments anymore. The potential EBIT and EBT contribution is pretty high. That development of ongoing amortization and the growth of the company is reflected in the development of our revenues, EBITDA and EBIT. All of them, over the course of the last 8 years, developed in an absolute linear way. So we still have, like in the beginning, in total in the group, currently 75% EBITDA margin and almost 44% EBIT margin. Please have in mind that there are sometimes some slight fluctuations in the EBITDA margin, EBIT margin, depending on meteorological effects. We strongly believe and plan for 2025 that we will stick with these margins. When I talk of 2025, why is that? Well, at the beginning of 2020, we announced our plan Fast Forward 2025. In these days, we had approximately 1.7 gigawatt of own capacities and planned to double the size of the company until 2025. So bringing up our capacities to 3.4 gigawatt. Now we are currently at 2 gigawatt and are full in plan. So we expect for the next 3.5 years, 1.4 gigawatt additional capacities. That should boost our revenues from currently 330 million euros to 440 million euros. And with a stable EBITDA margin of 75%, will boost our EBITDA from 256 million euro in fiscal year 2021 to 330 million euros. This linear growth will be shown in, as I pointed already out, in revenues, EBITDA and EBIT. But with the ongoing amortization of the group, there is a bigger leverage in the development of the earnings per share. So we will increase our earnings per share from 48 euro cents in 2021 to 70 euro cents in 2025. And all of that with a stable equity ratio of above 24%. Well, is that growth then the limit? No, it is not. This Fast Forward 2025 is considered to be the base case scenario for us. So we expect that there will be further growth, certainly due to the current situation and the new plans of the EU to repower EU until 2030. But these plans are not detailed, so we cannot integrate them in our plans yet. But beyond that, we already have seen opportunities for mergers and acquisitions to, by that, boost our scale and our scope to skim more economies of scale and scope. And we see some opportunities in storage technologies and maybe even outside Europe. All of these additional measures would certainly, if they have a certain size, need some equity market transactions, so maybe to issue shares. But the Fast Forward 2025, our base case scenario, is planned without any such issuance of new shares. Ladies and gentlemen, I hope I pointed out that we have a very stable business, which can be easily forecasted, which can be is very stable, which is not dependent on the overall commercial development. During COVID-19, by the way, we have shown that although there was a huge slump in electricity prices all over Europe, due to our very risk-limited business model, we were able to overfulfill our guidance in every year. For the last 8 years, we never have failed any of our guidance figures. And this is due to the fact that we have not only very controlled operations based on a very state-of-the-art IT infrastructure, but we have hedged, 90% are long-term hedged, price fixed via feed-in tariffs or PPAs, and 6% of our revenues are short-term hedged, and only 4%, so below 5%, we have some merchant exposure. So there is a very limited energy price risk for pretty long term for our parks. We are investing mostly in the Eurozone, so there is a very limited currency exchange risk. We have, as I pointed out, clear amortization schedules with fixed interest rates, so we have almost no interest rate exchange risk. We have a very secured liquidity in our hand to grow our business. As I pointed out, we do not have any impact from COVID-19 on the operating business. We have very regularly increased our revenues, our EBITDA and EBIT. We have a very limited development risk due to our strategic development partnerships. And due to our very protected business model, we have an investment grade rating of BBB- on corporate level. Well, ladies and gentlemen, the sun is shining, the wind is blowing independently from what's going on this earth, what the economy is doing. And so therefore, I hope I gave you now an insight into the business model of Encavis. Thank you very much for listening. Thank you very much for your interest. Goodbye.